In the last video, I showed you how to calculate the gain or loss on a foreign currency transaction. In this video, we're going to kick it up a notch. So let's say that we've got an export sale that occurs on November 15th. We've got a U.S. firm like the company Caterpillar, and they make a sale to a company in Europe, and so the sale is going to be denominated in euros. And so the U.S. firm makes the sale on November 15th, but they don't collect the money until February 15th, at which point in time they are going to collect 100,000 euros. And now you can see where we could have a potential foreign currency gain or loss, because what if the value of the euro relative to the U.S. dollar changes between November 15th and February 15th. Now, I showed you how to calculate that in the last video. What I didn't show you was, what if there is a fiscal year end in between when the sale is made and the sale is collected? How do we account for that? Let's say that this company, so Caterpillar, let's say their balance sheet date is December 31st. What if the balance sheet date occurs before the payment occurs? Okay, before Caterpillar receives the payment of the 100,000 euros. How are we going to account for that? So we've got the sale made, then we got the fiscal year end, but Caterpillar still doesn't have the money. And then after the fiscal year end, that's when they collect the money. So I'm going to show you the journal entries and walk you through this. So again, we've got November 15th. We've got the sale made. So Caterpillar is a U.S. company, so their financial statements are going to be denominated in U.S. dollars, but this contract is denominated in euros. They sell to a European firm that promises to pay 100,000 euros, and the cost of the equipment to Caterpillar, so for the cost of goods sold purposes, is $60,000. We'll use that in our journal entry. And the spot rate, so the exchange rate at the time, so November 15th is 84 cents. Okay, so 84 U.S. cents would buy you 1 euro. So that's the exchange rate at that point in time. Okay, now, so let's take a look at the journal entry. We would have accounts receivable of $84,000. Notice we're not getting any cash today. Okay, we're getting an account receivable, and then we're going to credit sales revenue for $84,000. So this is using the spot rate as of today, 0.84 times 100,000. That's where I got this 84,000 from. Now, they're not necessarily going to get $84,000, and that's where the gain or loss is going to come in. We'll get into that. And then we just debit COGS and we credit inventory for $60,000. That's just given information. So that's not really important here. So December 31st, now we have Caterpillar's fiscal year end. However, they still have not received the money from the European firm. But now, so you said, well, why do we need a journal entry? The spot rate has changed. So the spot rate on December 31st is now 86 cents per euro. Okay, so 86 U.S. cents will get you 1 euro. Before it was 84 cents. Now it is 86 cents. So we are going to debit accounts receivable and increase our asset here, accounts receivable, for $2,000. And then we're going to credit a gain. We're going to have gain on foreign exchange transaction. We're going to credit that for $2,000. That's going to go on the income statement, increase the company's profit, Caterpillar's profit. You know, most companies usually put gains and losses on foreign exchange transactions in the other income or other expense section of the income statement. Now, so we've got the fiscal year end, so the balance sheet date, December 31st. And now, February 15th, Caterpillar actually gets the euros, but now the spot rate, a spot rate might have changed again. And we see the spot rate on February 15th is now 83 cents per euro. So it originally was 84 cents, then it went to 86 cents, and now it's at 83 cents. So now we're going to need to make a journal entry. We're going to need to reflect the fact that we got this 83 cents per euro. So now we got a new spot rate, but we also have to reflect the fact that now we've got the money. We collected the euros, and we're going to convert it to cash and so forth. So what we would have is we would debit cash for $83,000. And if you're wondering how is it that we came up with 83,000? Well, we're getting 100,000 euros times 83 cents per euro. So 100,000 times 0.83 is 83,000. We're assuming that Caterpillar gets the euros and immediately converts it to US dollars. So we're going to debit cash, so that's going to increase our cash by 83,000. Now, ignore this for a moment. Now, we're going to credit the accounts receivable for $86,000. Now, you say, well, how do we know to credit the account receivable for $86,000? Well, if we had made a T account here for accounts receivable, okay, we started with 84,000. We had 84,000, and then this transaction here, we debited again for 2,000. So our running balance of accounts receivable is 86,000. Now, we need to take that off the books. We need a credit for $86,000. Okay, so that's what we're doing when we have this credit here for accounts receivable. Okay, now we're gonna have to have a plug because our debits do not equal our credits. So we've got a credit of 86,000 and we've got a debit of 83,000. Debits don't equal the credits, so we're gonna have right here a debit of $3,000. I crossed it out before so you couldn't see it. It's correct. So $3,000 debit. So then now we got $80,000 debit or $83,000 debit to cash, $3,000 debit, a loss on foreign exchange, which is going to decrease the company's profit on its on Caterpillar's income statement, and then we got a credit to account receivable of $86,000.